Hi, it's Lee, and welcome to the Test Economist. As I explained in my previous video, we should see some margin increases due to the price rises. Now, as Q2 was such a disaster, it's difficult to get accurate numbers, although we will use it as a guide as best we can. Instead, when it comes to margins though, we'll use Q1 as a guide. In Q1, we saw 30% margins without regulatory credits. Yes, absolutely amazing, and even more impressive when you do include regulatory credits. Therefore, I'm going to look at all the prices of the vehicles that were ordered for each model and variant from each factory. I'll go back and look at the previous instances of the website that match delivery dates for Q1 and record what the price was then. I will then do the same for Q3. From there, we'll be able to compare the prices and see how much the prices have increased from Q1 to Q3. I'm then going to include all these price increases as profit to begin with and see what results we get. Alright, that took a while, but I have all the answers of what we wanted. Now, firstly, I'm admitting that I am using a 30% margin all round for all the vehicles, models and factories that we got from Q1. I understand that was the overall average, but we are going to be using this more for indicative purposes to calculate how much the average margin has increased more than anything. So just bear with me and hopefully it will all make sense. The first columns are the price the vehicles were when they were first ordered and then delivered in Q1, i.e. not the price they were in Q1 due to the long waiting lists. Then the same for Q3. I've kept them in the local currency of where they were manufactured. Using this 30% margin, I've created another column of how much gross profit that equates to. Then I've created a column of the amount the price has increased, and then another where I add the price increase to the profit to establish the new profit. As we can see, the Model S has experienced some very high price rises due to its popularity of being the best car ever made, almost a 20% increase in price. However, it's not a major seller. What is more interesting is the Model 3. The rear-wheel drive is a big seller and it increased 4%, which increased the margin to 33%. The long-range price increased 10%, taking margin to a crazy 36%. Then, of course, the most exciting, the Model Y long range, which rose 11%, taking margins to 37%. Bear in mind, that Model Y has since risen to $66,000 now, which would mean 43% margin. Add FSD onto that, and it's 52% margin, assuming no deferred revenue. And people didn't believe me when I thought a Texas Model Y could have 45% margin without FSD. Well, you were probably right not to believe me, as I think it could be closer to 70% if it's software locked and has FSD. Yup, makes sense to hold on to your Tesla shares to at least see through the whole 4680 technology. What I didn't quite expect though was Shanghai. Although I was aware they'd raised their prices and I hadn't factored in the percentage in my head, we have Model 3 rear-wheel drive price increases of 11%, taking margins to 37%, and a 13% price increase on the most popular variant, Model Y rear-wheel drive, taking margins to 38%. Alright, this is insane. I don't believe many others are expecting to see margins increase this high. Admittedly, I have added all the price increases to profit and not accounted for any inflation. But I don't think we should be experiencing cost rises since Q1. In fact, we could argue the contrary. Apparently shipping costs are down to about half what they used to be. In case you didn't realise, the 0 to 60 times for the Model Y rear-wheel drive have increased from 4.5 seconds to 6.9. Of course, it's actually 0 to 100 kilometers an hour. And similar drops for the Model 3 rear-wheel drive. This is due to Tesla using a weaker, lower-cost motor. The massive ramp-up in Shanghai would reduce the average cost per vehicle too. Also, no extra logistics expenses trying to push out more deliveries for the end of the quarter. Although we haven't mentioned Texas and Berlin yet, the costs of delivering the Model Ys from Berlin no longer include import tariffs or shipping, saving further costs again. Okay, so actually what we first wanted to work out before margins was ASPs. This is fairly straightforward for Fremont, but we now have this strong US dollar for the rest of them. So I'm taking an average of the exchange rate throughout the quarter to best adjust these prices into US dollars as best we can. Now, bear in mind also that these are standard prices for the vehicles, as in no extras added. People often order bigger wheels, white interiors, and other paint colours. I don't add these extras in, as it seems to be more accurate that way. I don't always do what would be the most axiomatic method. I have done this so many times, and I see which ways tend to get the most accurate result. Anyway, I've included all the ASPs that I think are the most accurate relative to the exchange rate. Bear in mind that it is also possible that Tesla may have hedged the US dollar too. The euro dropped more towards the end of the quarter, but none of the exports reached their destination that was shipping from September, and people had to likely pay in full before they received their vehicle. So the exchange rate had not dropped as much for the European deliveries at the start of the quarter, but I have adjusted that somewhat too. This gives us an overall ASP of $53,000, up $1,000 from Q1, but actually down from $56,000 in Q2. Now, Q2 did also experience a lot of these price rises, but without the dollar being so strong. And those numbers do include FSD. So let's add FSD onto our estimate. And when I add FSD, we get an ASP of 54,500, which actually does feel better with me. Now let's add in our margins, which should be a lot higher than Q2. Although we have these great margins for Shanghai, we do also have this line upgrade that took out 2 weeks production, or 17%, perhaps 20% including ramping, and Shanghai experienced some other downtime too. So let's say we lost 20% of that quarter in Shanghai, and Tesla still had to pay the staff. There is a chance the line upgrade may affect OPEX too. I believe this was the case one time when they had a Model S upgrade. But we'll get to that, and we'll get told on the call if it is anyway. So if the materials are 2/3 of the cost of the car, and the production 1/3, then we lose 20% of 1/3 of our margin, or 1/15. Therefore, I'm going to subtract 2% from our Shanghai margins, taking them down from 36% to 34% each. Then we have Berlin. We know this is a profitable factory now, but margins are still low. Now, I'm afraid I have to guess here a little, and I'm going with 17%. And then the same for Texas, I'm going to guess 12%. That does affect our overall margin slightly, dropping from about 34% to just over 33%, even despite such low quantities. These margins may be a little bit higher though. Anyway, that is a margin increase of 3% from Q1, or 10% more margin if you like. This comes to $19 billion in revenue, and we've done everything we need now to even calculate our gross profit, which is $6.2 billion gross profit for autos. Great, so what does that mean? How does it compare with previous quarters? Well, if we remove the regulatory credits from the previous quarters, as we still haven't included those yet in this estimate, then Q2 was $3.7 billion in gross profit. But bear in mind, this was obviously a terrible quarter we had to deal with. Therefore, it might be a better comparison to look at Q1 gross profit, which was $4.8 billion without regulatory credits. Yes, that quarter had a very high $680 million in regulatory credits. That means this estimate is an increase of 30% gross profit from Q1. Factor in the fact that we are also about 20,000 vehicles short of being delivered that were produced, which would have actually taken us to $6.6 billion. And remember how I keep telling you, if we see big increases in profit, they get even bigger in operating profit. But you'll have to wait for my next video for the full earnings report. But you can already download my full spreadsheet for my earnings estimate in Patreon now. All in all, I'm very impressed with these margins, although there is always some reason we never get to see them felt in the financials fully. This quarter being line upgrades in Shanghai, and still these two new factories that are going to take time to get a decent margin. Although it sounds like Berlin is starting to ramp well, but obviously they both come down to 4680 cell production. So we'll get a better understanding of where we are with all that in the earnings call. The point is that these figures show that Tesla can create fantastic margins. They just need to get their ducks in a row, and the new factories will have even better margins and higher ASPs. So the profits they generate are going to do wonders for the company. It's what we're waiting for. and expecting to see sometime next year. Hopefully by the end of the year, even more crazy if the Cybertruck has hit its volume production too. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.